When it comes to investing, there is a quote that became very popular during the COVID crash, and that is, "Don't fight the Fed." And what it essentially means is that the Federal Reserve in the US is largely going to dictate what the stock market does. And as an investor, you basically just have to go with the flow. During the COVID crash, the Fed was on a mission to save the economy and keep people in jobs. And so this meant that there was a lot of quantitative easing, so in other words, splashing the cash, and historically low interest rates. And as a result, the stock market had one of the quickest recoveries in history, taking just 4 months to recover to pre-COVID levels. This was a time when bad news, like an increase in unemployment rate, really became good news for investors because it meant more stimulus. However, at the moment, we're in very different times. COVID is still lingering, but it's no longer really considered a major threat. Instead, we're facing a new challenge, and that challenge is inflation. The Fed and most central banks around the world have turned their attention to the rising cost of living caused by inflation. And inflation is currently running hot at the moment at 8.3% in the US and 6.1% here in Australia, which is well above the target range. This new threat has caused the Fed to do a complete 180 on its policies, and instead of quantitative easing and low interest rates, we're now in a period of quantitative tightening and increasing interest rates. And what they're essentially trying to do is to just cool things down and slow down the economy in order to bring that inflation level down. Naturally, this has been very bad for investments. Stock markets have been volatile as investors anticipate a drop in future earnings and consider if they're better off in defensive style assets, which, thanks to rising interest rates, you can now start to generate a return on. The Reserve Bank of Australia is predicting property prices to drop 15% over the next 2 years, and some economists are a lot more bearish than this, predicting a 30% drop. Long duration bonds haven't provided any safety from the carnage, as new bonds issued with a higher coupon rate are causing investors to sell out of the old paper. And not even gold is safe. Gold is often considered a hedge against inflation, but over the last 6 months, the price of gold is down 20%. The problem with the current scenario is that there is still a lot of uncertainty ahead. We don't know how much the Fed will need to continue to tighten in order to bring the inflation down. And you may have heard inflation referred to as the genie out of the bottle, or the inflation genie. And this basically means that once inflation is in the economy, it's notoriously hard to get back under control. This unfortunately may mean that more aggressive moves are ahead of us, which could lead to a prolonged recession and inevitably job losses. But let's take a step back from all of this short-term noise for a minute, and let's remember that there has never been a time in history where the Australian stock market or the US stock market hasn't recovered from previous lows and gone on to make a new high. And now, I don't think this time is going to be any different. The question is though, when? The recovery won't start until the Fed pivots on its policies and again starts to support the economy and businesses. And this won't happen until we start to see that inflation figure come down, at which point the Fed can stop this barrage of interest rate increases. Unfortunately, I have no idea when this is going to happen, and no one really does. But in the short term, I continue to remind myself that I am a long-term investor, and I am buying assets in a highly diversified, high-quality portfolio, which is in line with my risk tolerance and my investment time frame. And so really, this short-term volatility and the reduction in prices just means that I can buy a higher quantity of assets for the same amount of money than I could at the start of this year, which is a good thing. The decision to invest should be based more on your personal financial situation than it is on the short-term stock market movements, because one of those things is in your control and predictable, and the other is unpredictable and out of your control. So if you have your debts under control, you have an emergency fund in place, you've got certainty of income, and you've got good surplus cash flow, well, now might be a great time to start dollar cost averaging into a portfolio of high quality assets. But that decision should be based on your financial plan and not the short-term noise. But that's it for me today, guys. Thanks a lot for watching. I hope you enjoyed this little update. If you did, please give it a thumbs up, and I will see you guys in the next one.